Hello, I'm Tom Wallace, and this is Florida Funders Angel Investing in Florida podcast. If you're not familiar with Florida Funders, we're a unique hybrid, a cross between a venture capital firm and a crowdfunding platform. Our goal is to transform Florida from Sunshine State to Startup State. We like to say we're on a mission to make Florida as known for technology and innovation as it is today for tourism and strawberries. We have a really exciting show today. I'm really honored to have Peter Mallouk with us. Peter is the CEO of Creative Planning. Peter's really built a great company out there in Kansas City. I've known Peter for a while. He actually manages some of my personal wealth. He is up to, what is it, 48 billion under management, Peter?
Yeah, that's right.
Yeah, so excited to have you here. He's also a best-selling author. He's a rock star in the financial investing world. You've probably seen him on CNBC. So Peter, welcome. Thanks for joining me.
Thanks for having me. Much appreciated. Good to be with you, Tom.
Yeah, thanks. So Peter's a little different than most of the investors I've had on the show in the past, in that he really isn't an angel investor, but he really is so qualified as an investor. And I think during our conversation, Peter, one of the things that I'd like to kind of understand is how you look at investing and some of those investing truths and some of the stuff from your book, The 5 Biggest Mistakes That Investors Make, also actually are quite appropriate for angel investing as well. So why don't you tell us a little bit more about your background and your firm? I'm sure I just touched on it. The audience would like to know more about you and creative planning.
So creative planning's been around for a long time, and we manage about 48 billion. We've got clients in all 50 states, work with over 1,000 clients in Florida, have several very strong teams there. We are known for a few things. One is customizing portfolios. We work around a lot of people that have outside investments, like they own businesses, they own real estate, they're invested in alternative investments, and they're looking for people to work around them, take that into account in a very tax sensitive way. And we're also a family office. We practice law, we practice tax. We have a lot of different services here, from trust services all the way through, that we're able to help higher net worth families with. And so it becomes a lot easier than, most folks are the general contractor of their finances. They have their angel investment, they have their portfolio guy, they have their lawyer, they have their CPA, and we're able to really help them put all of that together, not just help them coordinate, but actually do the things for them that they need done. I think lastly, a lot of folks like that we're an independent firm, we're a fiduciary, we don't have our own products, we don't make commissions on our investments. So it's complicated enough investing, as you and your viewers and listeners know, without having an advisor who gets paid differently depending on what you do with them. And so we're able to sit on the same side of the table with the clients and look at the full universe of investments and help them navigate that too.
Yeah, that's great. That's one of the things I like about creative planning personally, is that your transparency when it comes to fees and not having not having interests outside of me, your client, and that we're completely aligned. So how did you get into this business, and what drew you to the world of investing and wealth planning?
When I started out, I was an advisor to other advisors. So I would either do legal work or planning work for other firms. So I do financial planning for their clients. Sometimes I'm a certified financial planner. I would set up wills and trusts or give tax advice on a business sale or exiting from an investment for other financial planners. So I'm an estate attorney, and I would advise on that. After doing that from 98 to 04, it took a while. Light bulb finally went off that, hey, it'd be neat to really put all of this together in an independent way, really tailor things for everybody instead of people that had just a ton of money. And that became the impetus for what creative planning is today.
And how you mentioned creative planning is 48 billion under management. How big's your firm? How many employees do you have? Be interested.
So across creative and affiliates like our trust company and so on, there's about 700 employees. We have 26, 27 offices throughout the country and clients in all 50 states now. So a lot of that's happened in the last 5 or 10 years. It's been a good run.
Good. Well, I know you have a unique approach to investing and in growing your clients' wealth. Tell us some of the principles of that.
So the overriding principle is customization. So in our practice, we have a small emerging wealth group that basically works with people that have under 400,000. We have a very, very large, tens of billions that we manage for people that are, we call them the millionaire or multimillionaire next door. They might have a couple $1 million and we're helping them navigate things. Then we have an ultra affluent practice, which tend to be people who sold businesses or stakes in businesses that have 10 million and up, or even much bigger numbers than that. The common thread, and the higher net worth, the more it matters, is customization. And I think that's what we're known for more than anything else is, hey, if you've got these 3 private investments and they're in this type of space and they have this sort of probability of a certain outcome, or if you're a business owner, how do we manage your investments and your trusts and charitable planning and tax situation in a way where all these pieces are communicating with each other to help you get to from point A to point B. That by far is the main thing that we're focused on. So if you have somebody who's invested in a startup, it's in the healthcare technology field, it's got 10% of their assets in it, another 20% are in illiquid investments. We're going to take a different approach with that individual than we would somebody else who has the exact same net worth but a different profile. And those are very big factors, as well as what state does somebody live in dictates a lot of the types of investments you have because of the way state taxes work.
Sure.
As people in Florida know, very, very well.
Yeah, absolutely. And people are moving to Florida all the time because of that now,
oh yeah,
as you well know. So your book is the 5 biggest mistakes that you see investors make. Tell us about that. What's the biggest mistake you see investors making?
It's a tie for me between confirmation bias and overconfidence. They're both behavioral. So the book talks about 5 different categories. I'm giving you 2 from the same chapter on behavioral mistakes. And I think overconfidence is usually the initial mistake, and then confirmation bias makes it worse. So people who have had success in the past tend to think that it was due to their brilliance, right? And sometimes that's the case.
Yeah.
But oftentimes, a lot of someone's success, including my own, there are a huge number of events and occurrences and people that created an outcome.
And there was probably some luck involved, right, too?
Yeah, a huge amount of luck. And so people tend to discount that and say, well, this happened for me and therefore it's because of me. And they take that overconfidence into their next deal. I think you see this in your business. I see it in mine. Very rarely do you see somebody, no matter how successful they were the first time, replicate that level of success or that pattern of success. And they tend to just be overconfident. There's a lot of research in the public markets around this, that when someone has a success with a stock, they're more likely to fail because they move into the next one quicker without as much research and diligence. But once people buy a position or a company, they tend to add money to it to keep it going, or they look for news they want. That's the confirmation bias element. So the example I like to use is if you're a Republican, you might watch Fox News, you might go to the Drudge Report online, you might read the Wall Street Journal. If you're a Democrat, you might watch MSNBC, you might go online to the Huffington Post, and you might read the New York Times. We constantly are going and looking for things that just validate what we're saying all the time, and we tend to discount things that disagree with our point of view. And investors really make this mistake in a very big way. You get invested in a company, whether it's public or private, and maybe it's turning against you. What do you start looking for? You don't start looking for reasons to dump it. You start looking for reasons to reaffirm why you bought it and that it's going to come back and so on. We tend to go find the news that we want to reaffirm our position, which is why people wind up holding on to things too long, and eventually things unwind poorly. So you combine those 2 behavioral mistakes. Those are the things that apply to angel investing, alternative investments, public investments, is the combination of those 2 and being able to recognize it in yourself and have a system in place to protect yourself against it.
Well, you brought up, doing due diligence, because when we look at the most common mistake that angel investors make, one of them is a lack of due diligence.
Yes.
They hear of a company, their friends are all doing it. There's the whole FOMO thing that, if they're being left out, and they throw 25 or 30,000 or 50,000 in, because even though they don't really know much, they don't know. Right. So due diligence is there's a lot of stats in angel investing. So if you do 20 plus hours of due diligence on every deal you invest in, your probability of returns increase significantly. And that's one of the things we do at Florida Funders for our investors, because we do well over 20 20 hours. We do more like 80 to 100 hours of due diligence for every company that we invest in.
So you have a formal process to protect yourself against the overconfidence effect, right? Of falling into the narrative fallacy, which is where a lot of angel investors, make mistakes, right? They go to the good story. They go to the good story and just invest there. You've got a process in place to protect against that.
Yeah, we like to think we do. I don't know if you can ever fully protect against it.
No.
Early stage tech investing is, it's a high risk asset class, but we try to mitigate that risk by doing lots of due diligence. Right. Now, the confirmational bias, I thought that was interesting, because one of the things that we look at a lot here at Florida Funders, and all angel investors do, is follow-ons. So once we make an investment as an angel investor, as Florida Funders, typically that company is going to be doing another round. And sometimes before they even get to maybe their Series A round, their next round, they run out of money. They come back to their investors and say, okay, should we do this? And so I was thinking about, as I was listening to you, this whole, because a lot of times you fall into that trap of, oh, I really like them. Maybe it's not gone as well as they thought, but, I still like the idea. I still like the founders, and you do some of this, what I guess you call confirmational bias, right? You look
right.
At so, but that's something that we work a lot in Florida Funders, because we really try to do we almost start over and say, okay, where is this company now? And if we were looking at it like we never invested it, would we write another check?
That's right. And I think that's the way to handle confirmation bias. I always tell people, look at your holdings and ask yourself what could go wrong. Not what are the things that are going to make it go right. If this business fails, what was the series of events that resulted in this business failing? And that's a great way to look at the lens. And then when it's time for a new round or a new deal, you start the whole process over to try to shed yourself of all the biases that have accumulated along the way.
Yeah, exactly. Now, I know you're not big on timing markets,
right?
And I think this is another area where you can go from public markets and the kind of investments that you're involved with to angel investing.
Right.
Tell us how you look at the timing of markets. And
well, I think there's definitely an overriding business cycle driven by interest rates that impact everything, right? When interest rates are very low, it costs very little to borrow money to hire employees or start a company. It costs very little to buy a building or to remodel a building. And so low interest rates really inflate all these asset classes and create a lot of money in the system that makes everything go well. So you could say, well, I can tie my market timing to that, because that's the biggest factor, the biggest indication of the expansion and contraction of the types of investments your listeners are making, as well as the public markets. The problem is you can't really time interest rates very well. If you look at the beginning of 2019, everybody was predicting interest rates would go up. Some crazy people were predicting they would stay flat. Well, they went down 3 different times. So it's very, very difficult. There's research going back where they interview the major economists at the Fed on where they think rates will go, and they're universally wrong, almost every single year. So you can't really, it's very hard to make decisions based on that. So you really shouldn't. Then you have all these micro events, like whether there's going to be a pandemic, coronavirus or Ebola or whatever. We can go back and there's always something, swine flu, terrorist events, wars, all these other things that macro hedge funds try to time their way through. There's just so much research that says the economy is too dynamic to be doing any of those things. And so market timers tend to get severely punished for their investment, for making, cash in, cash out decisions. The fully invested investor is going to beat the market timer over the long run, with a very high probability of that ending up being the case. And it's just because every time you make transitions, you have friction. You have money in cash, which is dead money for a while. You pay taxes on transactions and so on. The longer you can be committed to something, the more likely you are to have a good outcome.
Mm-hmm. So tell us about some of the other common mistakes you see investors making. And also, well, go ahead and do that, and then I'll get to my next question I have.
Well, I think, a big one that I talk about a lot is where are you getting your advice? So the financial advisors, I'm sure your listeners get hit up all the time, just being high net worth investors, people tend to find them very quickly. And there's 350 or 1,000 plus advisors. There's a lot of advisors. And people just think advisors are like doctors or lawyers or accountants who, all went to school and got a professional degree, got an advanced education, have to do all this continuing education, and have a fiduciary duty under the law to act in their client's best interest. You go to the financial advisor world, none of that's the case, right? The huge majority of people giving financial advice have no education at all, formal education in delivering financial advice. They have no designations of value related to giving financial advice, and they get paid for selling their own products, or they sometimes get paid on commissions, or they're set up in a way where they don't have a fiduciary obligation to the client. That's not some of the advisors. That's about 90% of advisors.
Yeah.
So if you really are trying to get to good advice, you want to start with who's between me and the investments that are going to be there. You really need to make sure that person is aligned with you, at least economically, right? Make sure that person doesn't make more or less if you buy one investment over another, or if you buy their own product. Sometimes the firm's own products, they use different names, or they have revenue sharing with a third party that gives them part of the fund. Second, make sure that your advisor has some education in the area they're giving you advice on. So you wouldn't go to an estate attorney that wasn't actually an attorney. Many people, especially your type of listeners that are getting their taxes done, are using a CPA. So demand the same from your financial advisor, and you're probably going to find your way to investments that are more aligned to your situation. Doesn't mean you're going to have great success, but it means you've increased the chance of having a good outcome by going through that simple process of, is my advisor educated, and are they aligned with me economically, and do they have a fiduciary duty to me?
Yeah, and what I like about creative planning is how transparent you guys are with your fees. So there's no hidden fees. I don't have to ever worry about, what am I paying for, and what's that look like? So
yeah.
I was thinking about some of the alternative asset classes, because obviously, you do asset allocation models for your clients, and there's, equities and bonds. Private equity, I think, is an alternative class you get involved in. Do you get involved in venture capital and investing in some venture capital funds? Do you do that? Do you guys do that?
We don't go to venture capital. So we do private equity, private lending, private real estate, some other alternatives. Venture capital is a little further out on the risk spectrum for our typical clients. If you think about our client has had a major liquidity event, or has a high concentration in some illiquid investments. So the people that would be qualified purchasers that would be interested in this type of area. And so for them, they're looking to us to diversify away some of the risk they're taking with everything else that they're doing. So for us to then take some of that and go put it in venture capital usually doesn't fit the profile of our typical type of client. We also invest in things. We have a general rule, not just that we're trying to make money, that the thing that we're going to buy has a very, very high probability of having a good outcome down the road. Now, that doesn't mean that it's going to do as well as something else, but we want our losers to be winners. We want them to have not as won as much as other things. And venture capital, the risk profile of it's just completely different than where our investment philosophy lies. We have a lot of clients that made their money in venture capital or as angel investors, but they're not coming to us looking for us to fill that void for them.
Okay. Well, one of the things that we talk to our investors about on a frequent basis is the need for this asset class to be a small portion of their net worth. We would never want somebody to even have 10% of their net worth in our asset class, but to have 2 or 3%. In industry stats are pretty impressive in returns in angel investing if you do it right. But again, that's right. Not making those common mistakes. For us, just you might find this. So diversification. I'm sure that's a big one for you too, right? So a lot of angel investors come in. They do 1 or 2 deals, 3 deals, and they all go to zero. And they say, "Hey, this doesn't work." There's a lot of research on this by the American Angel Capital Association of America that says you really increase your probability of return significantly once you get to about 15 angel investments. That less than that's pretty risky. So that's a pretty common mistake. And I would think that's a common mistake your investors make as well.
It is. We have all the time people bring us one deal and we tell them, look, if you're going to do this, you need to be prepared to do a dozen, or we need to go get you a fund, you got to go find a fund. We've got to find something that, because I think the typical person who gets pitched a deal or two that's an angel investment doesn't understand the risk. That what you said at the top of this, which is a third of these, in many cases, more than a third, maybe a third for you, but way more than a third for just a typical investor are going to go to zero.
Mm-hmm.
And I think most people aren't used to that profile of how investments work.
Yeah. Well, the other thing that we look at too on our side in angel investing is probably a little different from you all, but maybe not. Well, because I don't know how much you do active managed funds, but we look a lot at the jockey versus the horse. So, we're looking at the founder. We're doing a lot of due diligence on them, their backgrounds, how well they know the market, that sort of thing. Do you guys do that on the fund management side, or you're mostly passive? Correct? Is that?
Well, on the equity side, we're largely passive. On the alternative side, we're very active. So we are very focused on who the managers are and what their history is. So if we're looking at a private equity fund, we do think that how that fund, that group has done over the last 10, 20 years, if we are fortunate enough to have that long history, matters. And who is managing those funds matters. If you look at a private investment, the number one thing we would look at for a client when they're evaluating that is who are the people running it, and how long have they been doing this, and what were their past results. I mean, that's the number one factor by far. Then you get to, is there enough money? Is this idea going to work? All of those things.
Yeah. Some of the research in venture capital and angel investing is kind of interesting, and some of the latest research that we've been seeing, and one that surprised me recently was that the backgrounds of the founders in the industry that they were building their company or starting their company. And I would have thought that there was a strong correlation between a company. We have one of our companies, Rep Scrubs, which is a digital healthcare play. The whole team's from Stryker. So they came out of healthcare. They all have 20, 30 years in healthcare and working for Stryker. And that company's doing very well for us. But the research, and getting back to this point, was that it really isn't that tied together. They're not that correlated. So the fact that somebody has 10 years within that industry and they're starting a company within that industry, vis-a-vis compared to somebody who's just, they're starting and they really don't know that industry, but they're going to learn it. That surprised me, because I would have thought, industry expertise makes a lot of, it's significant.
Yeah, that surprises me a little bit, but I would differentiate that from somebody. I would much rather have someone who started a business and sold it successfully with coming into an industry with no experience than somebody who's been in the industry forever and not built a business from scratch and then sold it. To me, that experience of really finding a demand, finding a way to meet it, getting the people together to do it, raising the money, growing and selling it, that's a very unique skill set in and of itself. And so someone who has done that at least once, hopefully more, I'm betting on that.
Yeah.
Jockey way over somebody who's got 20 years of education and 20 years in an industry but has never done that before.
Yeah, well, that is sound advice, and you could be a good angel investor, Peter. The one that really surprises me in terms of if you look at some of the stats in the industry and what makes why certain investments are successful or not. And again, more recent research, there was always, especially in Silicon Valley, there was always this theory that if you're a serial entrepreneur, if you've done deals before, even if they failed, in fact, they almost wear like failure as a badge out there, then your chances of probability of success are greater because it's not your first rodeo.
Right.
And actually, some statistics have been coming out on that saying that's not really true. But you were saying if somebody's had successful exits and done it successfully in the past, that's a great indicator that they'll do it again. But if they failed, there's a fairly good chance they're going to fail again. So
I think there's a lot of ways to fail. So somebody who's failed, that doesn't prove a lot to me. I mean, you can do everything right and fail, but there are a lot of ways. To me, the success is the best indicator because there's so many variables that go into making this happen and to stay on the road that someone who's done that successfully, I'm far more interested in that. Whenever somebody brings me a startup deal or a private deal, I'm always looking at that first.
Yeah. Some of the other mistakes you see investors making on your side of the business, the other common mistakes.
I think that a lot of people don't have enough of a pool that's diversified. So what we like to see is we tell clients, like, you own a business, and we see this with our wealthiest clients. It's great you own a business. It's great you own this, big piece of land that's worth $20 million. it would be nice if you had a diversified portfolio that can meet your needs for the rest of your life. If you need $500 million for the rest of your life, let's set aside, depending on what we're going to do, $10 to $15 million in diversified, boring portfolio, and just make sure that you're set no matter what happens. Then take the rest of your money and go do whatever you want to do with it. You'll put 100% of it in one stock, great. You want to go do 3 angel deals, great. We're going to advise you on these different things. But if it doesn't work, we're not going to be saying, oh, this is terrible. We've got to change your lifestyle going forward. And now your kids aren't going to get what you thought, and so on. Mm-hmm. There's having a lot of wealth, and then it's what kind of wealth is it? Being worth $10 million and you have two $4 million homes is very different than being worth $10 million and $8 million in a diversified portfolio. So to me, the way for people who have a lot of illiquid investments, my opinion on how they should look at it is create a diversified pool to make sure you're independent for the rest of your life and to meet all your needs, your home or homes, whatever. Then from there, go do what you want to do versus wind up with 10 illiquid deals and 2 illiquid properties and a couple alternative investments. And if things go sideways, you could have a very permanent problem that was easily avoidable. You don't have to be in the game with every dollar you have. And you can be in the game with more confidence if you've really secured generational wealth in a diversified portfolio.
Mm-hmm. Good advice. One of the other mistakes we see angel investors making is what we call deal flow. And I use my brother as an example in this one because my brother Tim, I remember years ago he came to me and said, Tom, he's my older brother, how I can't tell him anything. He said, Tom, I'm not doing that angel investing anymore. I did 3 deals and then I went to 0. And that speaks to the diversification where we talked about. But I said to him, Tim, how many deals did you look at to do those 3 deals? He's like, well, I only looked at those 3. Somebody brought them to me. It was a friend's son, blah, 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 friend of a friend. And I said, well, that's one of the other common mistakes we see angel investors making. Yeah. So at Florida Funders, we look at about 50 deals to do 1. So we're very selective. And that process of going through that increases your probability of returns as well. And that's pretty well documented. Talking about your alternative investments, you mentioned private equity. Mm-hmm. And that you go out looking for the best private equity funds. Obviously, private equity and venture capital have a lot to do with each other. Mm-hmm. And there's a lot of different definitions. And the lines can get a little bit blurry, but mostly venture capital, as you know, is more risky earlier stage. Private equity tends to be much more later stage. They use debt. But in both cases right now, there's a ton of dry powder. Yes. There is so much money that's been raised, as you well know, I'm sure you know this. Yeah. There's so much money that's been raised for private equity and so much money that's been raised for venture capital. And in fact, I think I read somewhere, maybe it was the Wall Street Journal, that the private equity market will eclipse the total public market combined market value sometime in the coming years. And when you look at that dry powder, and what does that mean going forward to all investors? And any thoughts you have on that?
Well, I think we're seeing this issue everywhere. So I hear it in different contexts. Like to your point, you're saying there's more money chasing venture capital to private equity than ever before. There's now more private equity funds than there are publicly traded stocks, to give you a sense. But, also in the last couple of months, more money has been moved into municipal bonds than at any time in history. There's just a huge amount of money out there. And the publicly traded stocks, there are less of them than ever. They're going private, they're merging, less companies are IPOing. So we're seeing the public universe contract and the private universe expand. And you're seeing businesses that have 25 million to 500 million of revenue that were originally on an IPO path, they're staying in the private world longer. Why deal with all the crap of being a publicly traded company? There's so much money in the private equity space now that the multiples match and in some cases exceed the public markets.
Yes.
So we're seeing that happening now more than ever. But there's also more money than ever pouring into private lending. There's more money than ever pouring into real estate. There's a huge amount of liquidity, and the money is chasing all these assets. And part of the equation is interest rates are very low. You plug, an interest rate in your mouth on buying a property or buying a business, which is how private equity works. They borrow money, go buy a business. It's easier for the numbers to work. It's easier for the multiples to be bigger with interest rates so low. And I think that is really driving a lot of this, combined with people's irrational fear of public markets. It just makes no sense that if you buy a private company, somehow it's immune from the economic cycle that a public company is. But I think that's driving a little bit of it too. I see that with very, very sophisticated investors seem to think the private markets are safer. They're not safer. I think you can make more money in them, but you trade a lot of things for that. The risk is a little different. The obviously there's illiquidity. It's a little more expensive, a little less tax efficient, and you should outperform despite those things. But it's still correlated. It's still part of the way the economy works. If we have a 2008, 2009, and the stock market goes down 53%, the venture capital fund is probably not going to go up. The fee fund's probably not going to go up. But I think all those factors together are driving this gold rush.
The one last question I have for you as we get closer to wrapping things up here is this kind of case for angel investing. And Andreessen Horowitz, which is a big VC, kind of started this whole movement that's been going on for years where the tech unicorn companies that get over $1 billion value, they're waiting so long to go public. I mean, if you think about it, Airbnb isn't public yet. They're going to be worth $40 billion. Uber didn't go public till they were 70 billion in market cap. Facebook went public at 30 billion. And, the days of if you bought Apple at the IPO or you bought Amazon at the IPO, I think if you bought Amazon at the IPO, do you know what it's worth today?
I don't know the percent it's up. No.
I think it's 1,000 to 1. So,
wow.
I mean, the returns on Amazon, if you bought it and held it, but when they went public at, $100 million valuation or whatever it was. I don't know the numbers, but it was.
They just hit $1 trillion today, I believe. Yeah.
Yeah. So my question is, if we kind of make this case is, it's really hard to get in on these tech unicorns and these companies to get the kind of returns you were able to get, as little as a decade ago, because these companies are waiting so long to go public. So therefore you should angel invest. And do you know, I don't know if you saw it, you know who Mitch Kapor is? You know Mitch Kip?
No.
So he was the founder of Lotus 1-2-3. He put $75,000 in Uber as an angel investor. When it IPO'd, do you know what it was worth?
No.
$375 million. Now that's an outlier. Obviously, that doesn't happen all the time. But, so I was just curious in your thoughts on that. That how long and how late these large tech unicorn companies are waiting to go public, and how that affects investors.
Well, I think the IPO market's not as strong, and I also think that you're not seeing these companies go public to raise money necessarily. They're going public because they've gotten so big on the private side that they have to have a liquidity event for all of these investors. Mm-hmm. So it's really different than why companies used to go public in the past. They used to go public to get a bigger valuation and to raise money and issue bonds and all of that. And now it's just, we've gotten so big, we've got to somehow give, Uber has to somehow pay off Google Ventures and your friend and everybody else that's been sitting in it for forever. I think that's driving a good amount of it is this. There's just not the same reason to go public. I still think there's a huge amount of money that can be made without very high risk investments. And I think if you look at most of the folks invested in Uber, they were still funds, right? They were diversified funds that were invested in Uber. And to your point at the top of the podcast, they invested in a whole bunch of things that went to zero, and they got a couple things in there that hit a home run. And so I think if someone's going to go down that road, they really have to be, we share this view, they have to be very diversified, at least 15 different holdings, and hope that 2 of them work out for them.
Yeah. Well, Peter, this has been great. Thank you so much for your time. Is there any last piece of advice you'd like to give our listeners as far as investing goes?
Well, I think diversify. If you're an angel investor, you and I talked about that. And then outside of just there, have a pool of investments that no matter what happens in your investing world, you've got something reliable that's boring, but it's there for you. Keep that always on the side.
Great advice. Peter,
right.
Thank you so much. Appreciate it. Continued success with creative planning. I'm sure you will continue to be successful.
Thanks, Tom. I appreciate you having me, Tom. Thanks.
And to our listeners out there, floridafunders.com. If you're interested in looking at investing in early stage tech companies in Florida, go out to our website. We always have companies up. We're constantly scouring the state and finding the very best companies that are either in Florida or coming to Florida. And we've got a bunch of exciting companies up right now. So check us out, Thanks for your time. And again, Peter, really appreciate it.
Florida Funders is an early-stage venture capital firm that blends a venture fund and a crowdfunding platform. They are investing in some of the most exciting early-stage technology companies in the state of Florida.